Three training models that actually perform well in volatile markets. That's the topic of today's broadcast. Hi, this is Lode with Black Bear Dog Trading and welcome to my channel. In the prior video I talked about fixed trading, why it really doesn't work, why it's a recipe for disaster, at least if you plan on being a profitable trader long term. Today I'll be discussing what your alternative choices are and why you should seriously consider leaving the fixed trading model behind and learning to trade with one or more of the following components. The three models that I am talking about are dynamic trading, flow trading, and numbers trading. I already briefly discussed dynamic trading in a prior video, and I'll post a link to that at the end of this video, so if you want to check it out. But let's get over the three specific trading models, what they are and how they operate. Dynamic trading, as the name applies, it's an adaptive trading model that adapts to market conditions on the fly. What it means, it adapts to real life data, your stop loss, take profit, your risk percentage, your slippage, and even your spread as far as to maximum spread versus lowest spread based on brokers' sentiments are automatically adjusted on the fly. Disclaimer here, you cannot alter the spread. The spread is set by the broker. What that simply means is that it will check for maximum spreads to minimize risk. So dynamic trading is literally all the important key components of your trading method are adjusted automatically and on the fly based on a number of information, which is market sentiment, which is price data, volume, volatility, and things like that. That brings us to number two, and number two is flow trading. Flow trading is typically what professional traders use. They research data from banks, other financial institutions, hedge funds, companies that have billions under their control, and they check the data that these companies use to enter a buy or a sell trade. And based on the data that they analyze from those companies, they will then make their own buy or sell trade. The flow trading can go as far as actually using customer information to base their decision for a trade. When I mean customer information, I am not talking about one particular client who calls up and say, hey, enter a buy for X stock or X forex currency pair. No. What I mean is that they will take the average of all their clients and see where the majority of the clients are currently putting their money in and why that is the case. Thirdly, we have the model that is known as numbers trading. And numbers trading is exactly as it implies. It trades by numbers. Numbers that are based on past data, historical data, not numbers on live data. A prime example of what level of success you can reach with numbers trading is Mr. Jim Simmons, owner of Renaissance Technologies, who last year sadly enough passed away and left most of his knowledge hidden in a vault somewhere. But this man was known for being an arithmetic or numbers trading. This is often referred to, and lately you've been hearing quite a bit about it though, as quantitative or quant trading. It involves algorithms, mathematical equation, statistical data and analysis that is all based on past data, not on what is currently happening in the market. And based on the results of the formulas, trades are then taken in the direction that the formulas suggest. This is really very productive, but it's also very intense, as you can well imagine. But these are the three models that have proven and withstood the test of time to be highly lucrative in volatile markets. Again, I repeat, that's dynamic trading, it is flow trading, and it is numbers trading. So now, which one of those three should you focus on and why? That'll be the discussion of our next video. Please stay tuned for that. Until then, take care, have a wonderful day, and God bless.